All right, so are you ready to dive into this? Today, we're looking at earning passive income with crypto.
Definitely. I'm excited to unpack some of these strategies.
Yeah,
This article we have is a great starting point.
it really is. It can feel like such a jungle out there.
Yeah, sometimes you just don't know where to start.
That's why we're going to break it all down. I was blown away by some of the stuff in here.
Oh, yeah. Like what?
For example, did you know that back in 2021, people were earning up to like 180% APY through some of this stuff?
Oh, wow. Yeah, that was during the DeFi
It
boom.
was crazy, 180%.
Things were a bit wilder back then.
Yeah.
A lot of that was driven by insane demand and those early adopter incentives.
So probably not something we can just expect to replicate now.
Probably not those exact numbers.
Okay, good to know. So maybe we start with something that's a little less intense.
Sure.
This article talks about crypto lending as like the crypto equivalent of a savings account.
It's a good analogy.
So is that really what it's like? Just higher returns?
Yeah. So it's definitely a great way to dip your toes into earning passive income with crypto. Like one popular option is stablecoin lending.
Oh, okay. Yeah, I've heard about that. But how does that work?
So you lend out stable coins, things like USDC, on platforms like Coinbase, and earn interest just for holding them.
So is that like lower risk than other crypto stuff because it's stable coins?
Yeah, definitely less risky than lending more volatile cryptos,
Yeah.
but you still need to choose the right platform.
Oh, right. So it's not just about the coins themselves.
Exactly. There's still platform risk. You want to go with something reputable.
To avoid like hacks and stuff.
Yeah, exactly. You want platforms that actually care about security and transparency.
So like are Coinbase and Binance good examples?
Those are definitely two of the big names with pretty solid track records.
Okay, good to know. So once I've picked a platform, what kind of returns are we talking?
Well, stablecoin lending will usually give you between 2% to 10% APY, but it depends on market conditions.
That's still way better than a normal savings account, though.
Oh yeah, for sure. Way better.
But I guess it's not those 180% returns we talked about earlier, right?
Right. Those were a bit of an anomaly.
So trying to chase those kinds of gains is probably not the smartest move.
Exactly. Always remember, higher rewards usually mean taking on more risk.
Good advice. So let's move on to another strategy from this article. Staking. It says it's like earning dividends on stocks. Does that mean you're kind of like buying into the network with your crypto?
That's a good way to put it. So with staking, you're essentially helping to secure and operate a blockchain network.
Okay, so you're like an active participant, not just holding.
Exactly. You lock up your crypto to support the network, and in return, you get rewarded.
Sounds kind of technical, though. Do you need to be super techie to do it?
Not really. A lot of platforms make it pretty user-friendly. You don't need to be a blockchain expert.
That's good to hear because I'm definitely not a blockchain expert.
Mm.
But if my crypto is locked up, what happens if I need to access it?
That depends on the platform and the specific crypto you're staking. Some have lockup periods, some are more flexible.
Okay, so that's something to look into. What about the returns? The article mentioned Ethereum staking can earn you 4% to 12% APY.
Yeah, Ethereum is a popular one for staking, and those returns can be pretty good. But it can fluctuate based on a bunch of things.
Like what?
Well, the number of people staking on the network, overall market conditions, the specific cryptocurrency you choose, it's not a guaranteed return.
So even though it's considered safer than some crypto investments, there's still risk and volatility.
Definitely. It's always about balancing that risk and reward. You need to research platforms and coins carefully.
Okay, so it's not just a set it and forget it kind of thing.
Not necessarily. You need to stay informed and choose wisely.
So we've talked about lending and staking, but before we get to the more advanced strategies, I want to ask about this impermanent loss. This article mentioned it, and it sounds a little scary.
Don't worry, it's not as complicated as it sounds. Basically, impermanent loss happens when you provide liquidity to a decentralized exchange through a liquidity pool.
Okay, so what does that mean in plain English?
So you're essentially lending out two different cryptocurrencies, and the ratio of those assets can change based on what's happening in the market.
Okay. But how does that lead to losing money? I thought providing liquidity was supposed to be profitable.
It can be. You earn trading fees based on the volume of trades happening in the pool.
Hmm.
But here's the thing. If the price of one of those assets in your pair changes a lot compared to the other one, the ratio of your assets in the pool gets rebalanced.
And that's what causes the impermanent loss.
Yeah, because that rebalancing can leave you with a different mix of assets than you started with. So even if the overall value of your assets hasn't changed, you might end up with less of the one that went up in price.
So it's like a temporary loss based on how the market moves.
Exactly. And the impermanent part means if the price goes back to where it was, You haven't actually lost anything.
Okay, that makes a little more sense. But it definitely sounds like liquidity pools are riskier than what we've talked about so far.
They definitely are. They're not for beginners. You need to really understand how things work and be comfortable with the risks involved.
Okay, so we'll have to circle back to that later and break it down even more.
Definitely.
For now, let's talk about something that seems more beginner-friendly. Dollar cost averaging.
DCA. Yeah, that's a great strategy, especially for crypto.
So that's just investing a set amount of money regularly, regardless of the price, right?
Exactly. You're taking the emotion out of it and just consistently investing over time.
But wouldn't I miss out on gains if the market suddenly takes off? Wouldn't it be better to invest a lump sum when the price is low?
That's the classic dilemma. But honestly, timing the market is almost impossible, even for pros.
So with dollar cost averaging, I'm kind of averaging out my purchase price over time.
Exactly. You're automatically buying more when the price is low and less when it's high, without having to guess what the market will do next.
But does it actually work? This article said Bitcoin investments using DCA over the past 3 years have grown over 100%.
It's a solid strategy, especially for a volatile market like crypto. It helps you stay consistent and avoid those emotional decisions that often lead to buying high and selling low.
Okay, I can see why that's appealing. It seems much less stressful.
It takes the pressure off trying to be a market timing guru.
All right, so we've covered lending, staking, and dollar cost averaging. Before we wrap up this first part, I have to ask about day trading and yield chasing. Those sound a little bit, well, wild.
They're definitely more high speed and high stakes.
Yeah, I'm getting a bit of an adrenaline rush just thinking about them. Can you give me like a super quick rundown before we dive deeper?
So with day trading, you're trying to profit from short-term price swings,
So you're glued to the charts all day, buying and selling.
pretty much. It requires a lot of attention, skill, and risk management. You need to know what you're doing.
And what about yield chasing?
Yield chasing is like bouncing between different DeFi platforms to constantly find the highest returns.
So you're always on the hunt for the best rates.
Exactly. It can be lucrative, but it's also really risky.
Okay, that's definitely for more experienced crypto folks. I think I'll stick with my stablecoin lending and dollar cost averaging for now.
Those are great starting points.
But I'm definitely interested in hearing more about day trading and yield chasing, so let's make sure we come back to those next time.
Absolutely, we'll dive deeper into those and discuss the risks and rewards in detail.
Awesome. Well, folks, that wraps up part 1 of our deep dive into passive income with crypto. We've covered a lot of ground, from the simple to the complex, and we've only just scratched the surface. Join us next time as we delve even deeper into these strategies, share some tips for getting started, and explore what the future holds for passive income in the exciting world of crypto. Stay tuned.
Stay tuned. Welcome back. Ready for more crypto talk?
You bet. Last time we left off talking about day trading and yield chasing.
Yeah, the more intense strategies.
Exactly. And to be honest, they kind of make me nervous.
I get that. It's definitely a different approach.
So help me understand this. Why would anyone choose those over the safer options we talked about before? What's the appeal?
Well, day trading, it's all about trying to catch those quick price swings. Kind of like surfing, riding the waves.
But with money instead of a surfboard?
Exactly. It could be exciting, fast-paced, but definitely risky too.
Yeah, that's what makes me nervous. It sounds a bit like gambling.
There's definitely a speculative element to it, but it's not just random.
So there's actual skill involved.
Oh yeah, for sure. Successful day traders use technical analysis, chart patterns, all sorts of things to try and predict the market.
So it's not just about gut feeling.
No, there's a lot of learning and practice involved. There are even courses out there specifically for crypto day trading.
Like what?
Well, there's one called FOVA, for example. They teach you how to manage risk, develop strategies.
Okay, so it's not just blindly throwing money at the market.
Definitely not. It's about having a plan and understanding the market dynamics.
All right, that makes me feel a little better. What about yield chasing? That was the other one that seemed a bit crazy.
Yeah, that's where things get really interesting. It's all about finding the absolute highest returns possible in DeFi.
So you're like constantly searching for the best deals.
Exactly. Yield chasers are always looking for the most lucrative lending platforms, the best liquidity pools, the highest staking rewards.
So they're basically hopping from one opportunity to the next.
Pretty much. They're always on the lookout for the next big thing.
But isn't that super risky? What if these projects turn out to be scams?
That's a valid concern. There are definitely risks involved, which is why it's so important to do your research.
So even more so than with other crypto strategies.
Absolutely. You need to be extra careful and understand what you're getting into.
So yield chasing is not for the faint of heart.
Definitely not. You need to be comfortable with high risk and be ready to do a lot of homework.
Okay, I'm starting to get the picture. So let's shift gears for a bit and talk about impermanent loss again. We touched on it last time, but I'm still a bit fuzzy on the details.
Sure, let's break it down. Let's say you contribute to a liquidity pool with, let's say, 1 ETH and 100 USDC. And the price of ETH is $100.
Okay, got it.
So you've put in $200 total. Now imagine ETH goes up to $200.
Nice.
Right. But here's the thing. That liquidity pool needs to keep things balanced between the two assets.
So what happened?
So the amount of ETH in your share of the pool actually goes down, and the amount of USDC goes up.
Wait, so even though ETH went up in price, I have less of it?
Exactly. And this is where the loss comes in. If you were to withdraw your liquidity right then, you might only have like half an ETH and 150 USDC.
So my total value is still $200, but if I had just held on to my ETH and USDC separately?
You'd have $300. That's the impermanent loss, the difference between what you have in the pool versus what you would have had if you just held the assets.
Okay, that makes more sense now. So it's called impermanent because if ETH goes back down to $100, I haven't actually lost anything.
Exactly. It's temporary. But of course, there's no guarantee that the price will always go back to where it was.
Right, so it's still a risk to consider.
For sure. You need to weigh that risk against the potential rewards of providing liquidity, like earning those trading fees.
All right, so it's all about finding that balance, but good to have that clarified. So before we move on to the future of all this, any final thoughts on choosing the right strategy?
The most important thing is to understand your own risk tolerance.
Because what works for one person might be too risky for someone else.
Exactly. And it's okay to start small, experiment, and gradually get more comfortable with different approaches.
And I guess education is key, right?
Oh yeah, for sure. Learn as much as you can, don't be afraid to ask questions, and never invest more than you can afford to lose.
Solid advice. All right, so we've covered the basics, we've explored the risks, now let's look ahead. What does the future hold for earning passive income with crypto? What are your thoughts?
Well, things are moving so fast in this space, it's hard to predict exactly what will happen, but I think we're going to see even more innovation.
So much innovation, it's mind-blowing. But it seems like things are changing, right? Like, remember when we started talking about those crazy high returns from back in 2021?
Yeah, it felt like the Wild West of DeFi.
It did. But as we've been going through these strategies, it feels like passive income with crypto is becoming less about just chasing those huge, quick gains.
I think you're right. The focus is shifting towards more sustainable long-term strategies.
So it's less about getting rich quick and more about, like, building wealth steadily over time.
Exactly. And that's going to lead to some really interesting developments.
Like, what kind of innovations are you most excited about?
Well, for one, I think we'll see platforms become even more user-friendly. Earning passive income with crypto will be as easy as using a regular bank account.
That would be amazing, because right now it can still feel a bit intimidating for the average person, right?
Oh, yeah, definitely. But the easier it gets, the more people can participate.
And that means more people can benefit from the potential of crypto.
Exactly. And I think we'll also see more integration with the real world, like using crypto for loans or even earning passive income by supporting real-world businesses.
So crypto isn't just this isolated thing anymore. It's actually connecting with the traditional financial system.
Exactly. It's all starting to blend together.
That's a pretty big deal. It feels like we're on the verge of a major shift in how we think about money.
I think so, too. There are going to be challenges, of course, but the potential is huge.
Okay, so let's talk about those challenges for a minute. What are some of the risks or downsides we need to be aware of?
Well, scams are still a big concern, especially in the DeFi space.
Yeah, it seems like there's always a new scam popping up.
It's important to be really careful, do your research, don't just jump into anything that promises crazy returns.
Yeah, buyer beware.
Definitely.
Okay.
And another thing to keep in mind is regulation. Governments are still figuring out how to deal with crypto, and new rules could change the game.
So there's a lot of uncertainty.
For sure. And of course, there's always the risk of market volatility. Crypto prices can go up and down a lot.
That's a good reminder that even passive income isn't completely passive. You still need to be aware of what's happening in the market.
Exactly. You can't just set it and forget it completely. So if you're informed and cautious, the potential rewards are definitely worth considering.
Absolutely. So even though there are risks, it sounds like the future of passive income with crypto is super exciting.
I think so too. It has the potential to really change the way we think about money and finance.
Well, folks, we've covered a lot of ground in this deep dive. We talked about simple strategies, complex strategies, and what might be coming next. Hopefully, you're feeling a little more confident about navigating the world of crypto passive income.
It's all about learning, adapting, and staying informed.
Exactly. Keep exploring, keep asking questions, and who knows? Maybe you'll discover your own path to financial freedom with crypto. Until next time.
See you next time.